Good day and welcome to Curate Investment's Exhibiting Our Investment Artists webinar. My name is Natalie Harrison and it is a pleasure to be hosting you this morning. We have an exciting session ahead, but before we begin, just a few housekeeping points. We have applied for continuous professional development points for today's webinar, so to ensure your attendance is verified, please watch the full session and provide your ID number in the CPD section on the platform. The webinar platform will remain open until the end of June 2026, allowing you to revisit the session and still qualify for your CPD points. Once the full webinar has been viewed, the platform will automatically issue your CPD certificate via email. Today's webinar explores the theme, Breaking Through Bottleneck, Investing in a World of Scarcity and Standoffs. As part of the session, you will hear directly from two of the underlying managers within the Curate range. That's Visio Fund Management and Evenlode Investment. Importantly, today's session is less about traditional fund presentations and more about hearing directly from the investment managers themselves, understanding how they think, where they are finding opportunities, and how they identify businesses positioned at the center of powerful long-term trends. First up is Visio Fund Management, investment manager of the Curate Momentum Balanced Fund. Visio will unpack the topic, Who Controls the Chips, Controls the Future, exploring how one company, TSMC, has become central to the global AI ecosystem. From hyperscaler spending and semiconductor demand to the strategic importance of advanced chip manufacturing, the presentation highlights why certain businesses become critical bottlenecks in this modern economy and how Visio identifies these opportunities with the investment process. Thereafter, Evenlode Investment, manager of the Curate Global Quality Equity Fund, will present Owning the Toll Road, Compounding Through Constraints. Evenlode will explore the idea that some of the most resilient businesses in the world are not necessarily the most obvious. Instead, they are companies embedded deep within global systems, businesses customers cannot unplug, replace, or operate without. Through examples such as Relics, Clarksons, and L'Oreal, the presentation will showcase how quality businesses continuing compounding through disruption and uncertainty. As the session unfolds, please feel free to submit any questions via the Q&A function on the right-hand side of your screen. Our speakers will either address questions during the session or respond afterwards where appropriate. It is now my great pleasure to hand you over to Ofri, Co-Chief Investment Officer at Visio Fund Management.
Thank you, Natalie. The company we're going to be talking about today, if you've never heard of them, that's actually kind of the point, is TSMC. TSMC is one of the most important companies in the world, and somehow almost nobody outside of the industry knows what they do. Every chip that runs ChatGPT, Claude, or Gemini, every chip in your Apple devices, every NVIDIA chip, they all go through one factory operator on one island 90 miles off the coast of China. Today, I want to walk you through their story, how a 54-year-old engineer was handed an impossible job by a foreign government and accidentally built the most important industrial bottleneck of the 21st century. It's quite an amazing story. So what is TSMC and how did this happen? TSMC stands for Taiwan Semiconductor Manufacturing Company. They don't design chips. They make them on contract for the companies that do. Apple designs the brains of the iPhone, TSMC builds it. NVIDIA designs the trained ChatGPT, TSMC builds them. And here's the wild part. Even Intel, supposedly TSMC's biggest rival, is itself a TSMC customer for some of its most advanced products. Isn't it crazy the world's most famous chip company is outsourcing its hardest chips to the company it's been trying to beat for 30 years? Now, how did this happen? Because this is actually quite an interesting story. In 1985, the Taiwanese government called a guy named Morris Chang. Morris is 54, is Chinese-born, MIT trained, and has just been passed over for a CEO job at Texas Instruments after he spent 30 years there. He flies to Taiwan to head up the National Research Lab, basically a government engineering institute. 2 years later, the government comes back to him and says, actually, we want you to start a company, a semiconductor company. We want it to be globally important, and they gave him 3 days to write a business plan. Morris does. The plan is, we're going to build a factory that doesn't design any chips of its own. We're going to be a contract foundry, just manufacturing other companies' designs. At the time, the idea was considered insane. Jerry Sanders, the CEO of AMD, had a famous line about this. He said, "Real men have fabs," meaning that real chip companies own their own factories. The idea of a foundry-only business looked crazy. But here's what Morris had seen at Texas Instruments that nobody else had seen. He'd been watching brilliant chip designers for years quit and start their own companies and fail. Because to design chips, you needed a factory. And to build a factory, you needed billions of dollars. So the talent was trapped inside Intel, Texas Instruments, Motorola, designing chips for someone else's roadmap. Morris's bet was, if a foundry existed that those designers could trust, that promised never to compete with them, an entire generation of chip designers would quit and start their own companies. The market didn't exist yet. He had to build it. And one more thing about how the company started, because this is so different to the world today, Morris was given zero equity. He was essentially a government employee. He built up his stake over the years with his own capital. It took some time before his strategy played out, but chip designers like NVIDIA, Broadcom, AMD, Qualcomm, Marvell were all now viable businesses. Today, TSMC makes about 55% of the world's chips by revenue. But there's an asymmetry to it. They earn over 90% of the profits in the industry. And they make over 90% of the world's most advanced chips. If you're trying to make a chip at the leading edge today, there's only one realistic option. Now that you know what they do, let me pause to show you how the industry is structured. This funnel is what depends on TSMC. 5 layers of the modern economy. Up top, we have cloud computing, AI, high-performance computing. You have mobile phones. You got cars, which today are basically computers with wheels, and a long tail of industrial and IoT. Trillions of dollars of value, billions of users, and devices that you touch every day. All that funnels through the small group of companies in the middle, like Apple, NVIDIA, AMD, Qualcomm, Broadcom, the fabulous designers. They design chips, but they don't make them. And every single one of them, for their flagship products, ends up at the bottom of the funnel in TSMC. Another interesting point about this picture is that the companies in the middle are bitter rivals. Apple and Samsung are at war over mobile phones, NVIDIA and AMD over GPUs, Qualcomm and MediaTek over modems. They're enemies, but they all share the same factory. None of them have a plan B at the leading edge. We saw what happens when this funnel chokes, like we saw during COVID. That shortage wasn't even the dangerous part. That was a trailing edge chips. Those old, mature nodes that are made by multiple foundries from around the world. Even with the redundancy, the system choked up. if the equivalent thing happened to TSMC, leading edge production, there is no second source. No iPhones, no NVIDIA's AI chips, no flagship Android phones, no AMD chips. The entire premium tech economy just stops. Which brings us to the question we're really here to answer. Is AI a bubble? Because if it is, then TSMC becomes a cyclical foundry instead of a steady long-term investment. So I'm going to spend the next few slides looking at different demand metrics like tokens, hardware prices, electricity usage, and capex. And then we will look on the supply side, predominantly on Samsung and Intel. Let's start with tokens. A token is a unit AI models work in. Roughly speaking, a token is a chunk of text. Sometimes it's a word, sometimes it's a few characters. When you ask ChatGPT a question, your prompt is a few tokens going in, and the answer is a few hundred tokens coming out. Tokens are how the industry counts demand. So how much is being computed? Let's start with Google. In April 2024, Google generated 9.7 trillion tokens a month. By May 2025, it was 480 trillion. By July, 980. By October, 1.3 quadrillion. And in the latest disclosure, we estimate this figure is up another 60% to around 2 quadrillion. With OpenAI, you have 900 million people using ChatGPT every day, 18 billion messages a week, 2.5 billion prompts a day. On the developer side, Sam Altman disclosed last October that OpenAI's API was processing about 8.6 trillion tokens a day. 2 years before that, the number was 130 billion a day, a 65x increase. And that was in October. By Q1 of 26, it was up another 60%. If we look at Anthropic, slightly different metric, their annualized revenue went from $375 million from a year ago to $30 billion in April. The CEO told investors they had planned for a 10x growth this year. In Q1 alone, they delivered 80 times. Anthropic is now renting Elon Musk's old data centers because there isn't enough leading edge compute capacity anywhere else. And one more data point, Microsoft. The AI business, Copilot plus Azure AI, is now $37 billion annual run rate. That's up 123% year on year. 20 million paid Copilot seats sold into enterprise. It isn't trial usage. This is real recurring revenue from companies that have made a decision to make AI part of how they work. So here we have shown 4 different companies. It is not a fad. It is not concentrated in any single name. One more thing before we move on. All of this growth has happened despite a shortage in compute. Okay, second lens, hardware prices. If AI demand were moderating, if the bubble theory were right, you'd expect the cost of renting NVIDIA chips to be falling. That's generally what happens with every commoditizing technology. But GPU rental prices are up 40% in 5 months. And then on the H100, which is an older technology of a couple of years ago. And the third lens is power. This is actually the cleanest signal of all because it's something you cannot fake. You cannot run a GPU without electricity. So if AI is real, it has to show up in the grid. In 2022, global data center electricity consumption was 460 terawatt hours. By the end of this year, it will be over 750. A doubling, nearly doubling in over 4 years. To put that into perspective, global data center electricity is now somewhere between Japan and India's entire annual electricity consumption, just for data centers. AI's share of that in 2022, AI was about 5% of data center power. Today it's between 35 and 40, and by 2030, it will probably be around half of all data center electricity globally. Why is this a clean demand signal? Because every one of those megawatts represents a chip that's racked, plugged in, and running. There are no dark GPUs. Hyperscaler utilization is above 90%. When a new chip generation ships, the old one doesn't go into a landfill, it keeps on running. We have not heard of any decommissioned AI data centers yet. But there is a nuance in this chart that I want to point out. First, on the hardware side, each new NVIDIA generation has roughly doubled the AI throughput per watt, going from A100s to H100s to Blackwell to Rubin. Cumulatively, that's around 5 to 10x more useful compute per watt than what we had in 2022. Then there are improvements on the algorithms. These are increases in the efficiencies through better architectures, training, and smarter inference. These improvements are halving the power consumption every 8 months. So when you take those two things together, hardware and algorithm efficiency, the useful AI capability you get from a megawatt today is conservatively 100x what it was in 2022. Here's how it looks like for TSMC side of the equation. 3 years ago, in 2023, AI accelerators were about a quarter of TSMC's most advanced chip output. The big customers was smartphones, mostly Apple, and AI was a side business. This year, AI is 60% of TSMC's leading edge output. Next year, it's projected to be over 80, and so in 4 years, AI has gone from a side hustle to almost the entire leading edge production. What is getting squeezed out is mostly smartphones and computers. A big driver of that has actually been the pricing of both logic and memory and the impact that that's having on the price of the final products like the iPhone. Three years ago, the top 5 cloud companies, Microsoft, Google, Amazon, Meta, and Oracle, collectively spent about $240 billion a year building out cloud infrastructure. By 2025, that was $400 billion. The number people had penciled in for 2026 was around 450 to 550. Then Q1 earnings came about 2 weeks ago, and the picture got a bit steeper. Microsoft will spend $190 billion this year. Google, $185. Meta, $135. Amazon has spent $43 billion in just the first quarter. The top 4 combined will be over $650 billion in 2026 alone. But there's an important detail here. 3 of those 4, Microsoft, Meta, and Google, all name the same single line item when they raise their CapEx guidance: component pricing. There are 2 elements here. The one is memory, and the other is higher prices from TSMC. And to the question of whether this CapEx is reckless, Sundar Pichai, of the Google CEO, has said publicly multiple times that Google would spend more if they could. They're constrained not by their own balance sheet, but by what TSMC and the memory suppliers can physically build. They see the returns on the investment both from internal usage and from the AI models that they provide. So we've talked about how much AI is being computed, but what does that compute actually buy you? Because if all this compute just made AI 5% better, then yeah, we're probably in a bubble. Here's a popular analogy. Compare AI capability to the education ladder. In 2022, when ChatGPT 4 came out, that was trained on roughly 25,000 chips. The capability level was a high school graduate. It can pass standardized tests, it knows general knowledge, and can do basic reasoning. In 2024, Claude 4 and ChatGPT 5 came out. Those were trained on about 100,000 chips. The capability level was a university graduate, can pass the actual bar exam, the right working production software, and they do graduate level analysis. Today, the frontier models are trained on around 250,000 chips. The capability level is around a PhD student. They can take on multi-hour research projects. They debug entire code bases without human supervision. They build end-to-end financial models. And we've had a glimpse of the hacking capabilities of Anthropic's Mythos model. In 2027, Rubin Ultra will come out, and those clusters of around 1 million chips. And the expected capability of that will be a senior professional, 5 to 10 kind of years of knowledge work experience. And beyond that, we might get to superhuman genius levels. What we have seen so far, and we are making the assumption that it continues, is that every time a training compute scales 10x, the models climb one more rung up the education ladder. We've gone from high school to university, PhD, senior professional. That's what the additional 10x of training compute is buying. So we've talked about demand. Now let me turn to the supply side. Why hasn't anyone else done this? Samsung is one of the largest, most engineering-rich companies in the world. They have basically unlimited capital. They have the technology. Why are they not catching up? The answer in one word is yield. Yield is the unglamorous term for the percentage of chips that come off a wafer that actually work. When you build chips at this scale, manufacturing defects are unavoidable. The question is, what fraction of your output is good and what fraction is paperweight? At the current 3 nanometer generation, Samsung yields have been stuck at around 50% since production started 3 years ago. TSMC is at over 90. This sounds like an engineering problem, but it's actually a financial one. Because when a customer buys a wafer, they pay the full price whether 50% or 90% of the chips won't work. At Samsung's yield, your effective cost per working chip is almost double. No major customer will sign up for that. So the customer losses have piled up. Qualcomm's flagship Snapdragon has moved entirely to TSMC. Google's Tensor chips have moved to TSMC. NVIDIA's Rubin went to TSMC without any serious Samsung evaluation. Even Samsung's own phones now use Qualcomm chips made by TSMC for some of the flagship models. Samsung is losing customers in its own backyard. This could change, but capacity is an even bigger bottleneck at Samsung or Intel. The chart on the left, you can see the scale of the production gap, and by the end of this year, TSMC will be producing 280,000 wafers per month at the most advanced 3 and 2 nanometer nodes combined. Samsung's 2 nanometer target is about 21,000 wafers per month. Intel's first 18A fab in Arizona starts at around 10,000. TSMC is producing 10 to 1 against its 2 main competitors combined. And with Samsung and Intel, a lot of that production is actually for internal use, not for external customers. Then there is also the switching costs to consider. NVIDIA can't call up Samsung tomorrow and say, we're moving production over to you. It takes 2 to 3 years to prepare the fabs, get the process right, get the yields up. The chip designers are working with TSMC today on chips that will only come out in 2 to 3 years' time. Why is catching up so hard? Besides working with the most advanced machines man has ever created, there is a continuity to learning. You build up knowledge and know-how through every iteration, and the iterations are not particularly cheap. Here's what I mean. TSMC spent $30 billion on CapEx in 2022, $38 billion in 2024, over $50 billion this year. And every dollar of this year's CapEx is funding the research and the tool orders for a chip generation that will be in production 3 to 5 years from now. You miss a year and you've missed a generation. And here's also an important detail. You cannot skip generations. The physics and the process knowledge needed at each node builds directly on the one before. A new player can't go from 3 nanometers to 1.4. They have to do 3, then 2, then 1.8, 1.6 in sequence. And each step is harder than the last. Intel learned this the hard way. In 2016, Intel had a delay at 10 nanometers at just one node, 3-year delay. That single missed generation cascaded. Intel lost the data center CPU lead to AMD, which was using TSMC. By the time Intel got 10 nanometers working, 5 years of compounded process learning had been lost. They are still catching up today. One missed generation, 10 years later, and they're only kind of starting to come right. So when you hear about the new entrants like Elon Musk's Terafab or Japan's Rapidos, the new CHIPS Act fab in Arizona, it's not enough to build one factory. They need to commit to a multi-year, multi-$100 billion investment path, executed without major missteps against a competitor with 30 years of cumulative learning. That is the real moat. Now let me give you a little bit of a more mathematical way of why this industry favors one winner. There are 2 laws that govern this business. The first, you've probably heard of, is Moore's Law. Moore's Law states that compute per chip doubles every 2 years. That's been roughly true for about 60 years. What Moore's Law rewards is scale. The more volume you run through your factory, the lower your unit costs, the more you can invest in the next generation. So Moore's Law makes the big get bigger. The second law is much less famous. It's called Rock's Law. Rock's Law says that the cost of building a leading edge fab doubles every 4 years. Today's fabs cost about $30 billion. Next generation will be 60, and the one after that will be well over $100 billion. Now combine those 2 laws. The bigger you are, the cheaper you can produce, and the upfront cost of producing doubles every 4 years, and that leads to consolidation. And historically, that is what we've seen. In the early 2000s, there were 22 players making chips at the leading edge. By 2021, we were down to 2 players, essentially TSMC and Samsung. By the next transition, we would be down to 1, but geopolitics will probably keep more alive. TSMC is one of the bottlenecks, but it's not the only one. There are others. The biggest other bottleneck is memory, specifically the kind of memory called high bandwidth memory, which is very integral to AI. High bandwidth memory is made by 3 companies, SK Hynix, Samsung, and Micron. There's a huge shortage of supply, and prices are up significantly in the last year. The second is equipment. The machines that make the chips, the suppliers to TSMC. There's one Dutch company, ASML, that makes the most advanced of those machines, the EUV lithography systems. ASML itself is a monopoly, and they are the only company in the world that makes those machines. If ASML cannot ship enough tools, TSMC can't expand capacity. The third is advanced packaging. This is the way the chips get stacked together into a single package. TSMC does most of this in-house, but it is another capacity bottleneck. And the fourth is electricity. Total power output in the US has stagnated over the last 2 decades. Suddenly today there is a need to build power plants, substations, transformers, grids, but the capacity and the skills are not there to meet the demand. Now, none of these are currently broken enough to break the thesis, but they're worth watching because a thesis like this is not just TSMC on its own. There are 3 key risks worth taking seriously, worth talking about. The first one, and this is really the big one, is Taiwan. There is no plausible replacement for TSMC outside of Taiwan for 3 to 5 years. any scenario involving military action in the Taiwan Strait is catastrophic, not just for TSMC, but for every Western technology company that depends on them. This is the standoff part of what we're talking about today, and it's real. You might hedge it by owning an Intel or a Samsung because they would have the chance to catch up and the only ones who could supply the chips. TSMC is investing in backup capacity in Arizona, Japan, Germany, but those facilities are years away from leading edge production. The Arizona fab makes chips, but it makes chips a generation or two behind what Taiwan is producing. So if you're worried about Taiwan, you are worried about TSMC. Number 2 is customer concentration. Currently, Apple and Nvidia together are about 35% of TSMC's revenue. Apple has recently signed an agreement with Intel. There are no real details about it, but it would probably depend on Intel's progress on the latest node and the ramp up, which is still a few years away. It is also Apple's way of geopolitical risk. The third one, and this is a bit of a longer term one, is the next transistor architecture. TSMC's current lead is built on specific transistor designs. The next generation requires new physics and new equipment. If a competitor gets there first, the moat narrows. These architecture transitions are when industry leadership has historically changed hands, so it's a watch point, but it's still a few years out. So we've made the case for the company. The next question is, at what price? Since we've put these slides a couple of weeks ago, it was on a 19.3, it's now on a 21 times forward PE. The return on invested capital is at around 26. Return on equity is at 35. The 5-year revenue growth historically has been 23% annualized. Gross margins are running at over 65% and projected to keep climbing with a new generation of chips. The balance sheet has a net cash position, meaning that the $50 billion annual capex program is entirely self-funded. They don't need the bond market, they don't need a rights issue. They print money and reinvest it at a very high return. Conservatively, on our numbers, TSMC will grow at over 25% per annum through volume growth and pricing power. Even if there is no re-rating, there is a pretty decent return over the next few years. And that is why it's a core holding in our portfolio. Thank you.
Thank you, Ofri. Fascinating insights into how critical and concentrated the semiconductor ecosystem has become. What really stood out was the idea that while AI feels limitless from a software perspective, the physical infrastructure behind it is incredibly constrained. Whether it is hyperscaler spending, power demand from data centers, or advanced chip manufacturing capacity, many of the world's biggest technology trends are now flowing through a very small number of strategic businesses, with TSMC sitting right at the center of that bottleneck. And I think that is what makes the Visio approach particularly interesting. The team spends a lot of time identifying large structural themes early, but then pairing that with a disciplined portfolio construction and risk management framework within a broader multi-asset framework. If I just move briefly onto the Curate Momentum Balanced Fund overview slide. The fund is designed to generate returns well ahead of inflation over time while maintaining a strong focus on capital preservation and downside protection. The portfolio has the flexibility to invest across equities, bonds, property and cash, allowing the Visio team to position around their strongest global and local investment opportunities. March was admittedly a more difficult period for performance, with markets coming under pressure amid heightened geopolitical tensions and war-related uncertainty. However, the fund has since recovered very well and importantly continues to outperform peers since inception, reflecting the benefits of its long-term flexible and high conviction approach. And I think today's TSMC discussion is a good example of that philosophy in practice, identifying structural global opportunities while still balancing valuation, portfolio construction, and effective risk management. The fund remains particularly well suited to long-term investors and retirement savers looking for a diversified solution focused on real returns over time. Next up is Chris Elliott, Chief Investment Officer at Evenlode Investment and Portfolio Manager of the Curate Global Quality Equity Fund.
Great. Thank you, Natalie. In the next 30 minutes, I want to give you a new lens on the question that's been asked today, an understanding of why the choke points in the global economy that worry investors the most may not be the ones that matter the most for long-term returns. This year's showcase theme, scarcity, standoffs, and fragmenting trade flows, point towards physical geography. I'm going to argue that that's the wrong place to look. To briefly introduce myself, I'm Chris Elliott, CIO at Evenlode Investment and a fund manager on the Curate Global Quality Equity Fund. Now, when investors talk about scarcity and standoffs in 2026, they tend to point to the same handful of places on the world map. The Strait of Hormuz, at the center of a live Middle Eastern conflict, where a quarter of the world's seaborne oil still has to physically pass. The Taiwan Straits, where a single company makes the chips the rest of the technology industry depend on, or container ships being rerouted due to droughts closing the Panama Canal or increased risk of privacy across many major waterways. These are real constraints. They do matter. And capital allocators are right to think about them because markets do respond. Energy spikes when the Gulf gets tense, or shipping rates jump when trade routes close. But these market responses tend to fade faster than the headlines would suggest. However, there are other types of checkpoints, and for long-term investors, we would argue that these are the ones that matters most. These are the more durable ones, the ones that quietly shape returns over the spans of decades, not simply weeks. They're economic, not geographic, and they sit inside the way a business operates, not on a map where things move. We call these economic choke points toll roads. And to be clear straight away, we don't mean the type with tarmac and a barrier. We mean businesses where the customer doesn't really have a choice about whether to keep paying. Not because of a contract that locks them in, but because unplugging the relationship would be more disruptive than it's worth. The toll isn't large, but the road is hard to leave, and every year more traffic flows down it. Now, that description probably sounds close to something you've heard before, words like economic modes or competitive advantage or pricing power, and there is an overlap. But the toll road image captures something that those other words miss. A moat suggests a defensive fortification, where a toll road means a small recurring fee paid voluntarily year after year because the alternative is worse. And that distinction matters. So what do these toll roads look like in practice? Let's consider a few examples. The first archetype is a business that customers can't unplug. This could be the software that a finance team uses every day, or an ingredient that is specified into a product's formula and has been tested and approved by regulators. The cost of leaving isn't the cost of the service or product itself. It's in retraining users or in the cost of new inspections and approvals. And importantly, the cost to switch is higher than the gain to the customer from switching. The second archetype is the business that customers can't replace. And this is subtly different. The switching cost itself might be fairly low, and any customer could, in theory, go elsewhere. But the question is where? When a business's value comes from the breadth of participants, transactions, or the data flowing through it, there is a natural consolidation of supply to either a single company or a very small group of companies. For instance, a marketplace where every serious participant in an industry is already trading, or a contributory data utility that everyone in a profession quotes from, but more importantly, contributes to, are very, very stable businesses. Going elsewhere doesn't just entail the costs of switching. It means that relying on a smaller, thinner version of the same product or service yourself, and that has a real cost to the end user. The third archetype is a business with a range of products the retailer or distributor can't afford to omit. The branded consumable that earns its shelf space every year because if the supermarket doesn't stock it, the customer will switch stores rather than switch brands. The toll here isn't paid by the end consumer. Instead, it's paid by the retailer, who accepts less favorable margin terms because the alternative is losing the customer entirely. 3 mechanisms: can't unplug, can't replace, can't omit. Each one a different reason a customer keeps paying, but the same underlying shape. Now, it's important to understand that not everything that looks like a toll road is actually one. A physical choke point often feels like a toll road, but the test is whether that choke point is durable or just temporary. Ships can be rerouted, pipelines can be redirected, and new refineries can be built in different countries. That is why many physical choke points are often only temporary in nature. And a choke point that holds only as long as the alternatives are more expensive is a cyclical advantage, not a durable one. And to be clear, this is not a physical versus virtual debate. Not all software can be a toll road either. A productivity tool with 3 good substitutes is a feature on a roadmap, not a choke point. The test is whether a customer's workflow depends on it, not whether the product is good. Good products can be replaced and technical innovations copied. Embedded workflows can't be. So, as you can now see, the definition of toll roads is much narrower than it looks, which is why when we apply it strictly across a global universe, we end up owning only between 30 and 40 businesses. What's more, we have observed that these types of businesses often do better when the world gets more complex, in times of scarcity and standoffs. And there are 3 reasons for this. The first is that complexity is a tailwind for incumbents. When the world gets complicated, decision makers retreat to what they already trust. They don't shop around. A finance director that's already worrying about tariffs and currency and a board that wants weekly updates is not going to spend the year evaluating a new accounting platform. Importantly, this demand is asymmetric. Trusted suppliers gain share faster in hard times than they lose it in easy ones. Once relationships deepen for a difficult period, they tend to stick. So when a customer comes to review the vendors, the incumbent has another year of evidence demonstrating that they provide an indispensable service. Disruption ratchets the relationship, but calm doesn't reverse it. The second reason is pricing power, and I want to be very precise about what this phrase actually means, because it's one of the most overused terms in our industry. Pricing power isn't just the ability to put prices up, it's the ability to put prices up without losing the customer. Anyone can raise a price. The question is what happens next. If a commodity producer raises prices and peers don't, they will lose volume. A business with no real substitute raises prices and the customer pays. The difference isn't the size of the increase, it's about the customer's response. And the third reason is about capital intensity. And this is the one I find most interesting because it's often the least talked about. The world we're investing into now is one where capital has become genuinely expensive again, after 15 years of being almost free. Interest rates are higher and likely to stay higher against the 2008 average, and the demand for capital has skyrocketed. The energy transition demands capex. AI infrastructure demands capex. Reshoring demands capex. European defense rebuilding demands capex. Almost every macro narrative you read ends the same way. Somebody is going to have to spend a lot of money on physical assets. Now, in this capital-heavy environment, businesses that don't have to spend are quietly advantaged. They don't have to choose between investing in growth and returning cash to shareholders. They generate cash, reinvest a very small fraction, and can return the rest. And critically, the cash that they return is worth more in present value terms than it was when rates were near zero, while the capital-heavy businesses must compete for funds and are seeing their cost of capital rise. So, complexity drives customers towards the suppliers they already trust. These suppliers have structural pricing power, meaning they can increase prices without losing volumes. And this generates a stream of steadily growing cash flows that they can use to fund reinvestment, and is even more valuable when capital is expensive. 3 reasons stacked one on top of the other. So how do we take advantage of these long-term dynamics? The way we run this fund is straightforward. We're trying to find and own a concentrated portfolio of businesses that genuinely have these toll road economics. The discipline is in finding them at an attractive entry price and in saying no to everything that doesn't fit. So what's on our checklist? We want recurring revenue, meaning the business sells something its customers buy again and again, year after year, without having to be repersuaded each time. Pricing power, which is the ability to put prices up and retain the customer, importantly. And we want low capital intensity, meaning the business doesn't have to keep plowing money back into factories, fleets, or networks just to stand still. And very importantly, we want a position that the customer really doesn't have an alternative to. It seems a very simple checklist, but the reality is that the vast majority of companies don't pass it. So let's have a look at a few examples that do. The first is RELX, one of the largest positions in the fund. RELX runs 4 businesses: scientific publishing through Elsevier, legal information through LexisNexis, risk and data analytics, and exhibitions. The first 3, which together generate the vast majority of profits, are essentially the same business model. Indispensable datasets of professional information that customers pay for every year, and where the value of that dataset goes up as more records are added. This is the can't unplug archetype made concrete. Take LexisNexis, the legal research dataset. A law firm builds its entire research workflow around it. Every lawyer in the firm is trained on it. Every case file references prior research conducted through it. So the cost of switching isn't the subscription. It's in retraining every lawyer in the firm and accepting that something will go wrong with a citation that no one can predict in advance. So the firm doesn't switch. And every year, LexisNexis adds more cases and more analytical tools, which deepen the integration further. The toll road gets harder to leave the longer you've been on it. Now, in the current market, AI is the obvious challenge to a business like this, and we should address it here. What we've seen so far is that businesses inside RELX are using AI themselves to deepen their offerings rather than being disintermediated by it. The proprietary content, the trusted citations, the workflow integration, these are the things that AI tools need to draw on to build more value, and that they can't necessarily replace. We'll continue to watch it very carefully, but the early signs in the organic growth acceleration provide evidence that the toll road proposition is being reinforced by AI, not threatened by it. The second example sits right in the middle of the physical choke points we opened with. Clarkson is a 170-year-old shipping broker based in the UK. When a tanker wants to charter a vessel or a commodity trader needs to move a cargo of iron ore, Clarkson sits in the middle, matching the parties, taking a small commission, and gathering market data with every transaction. This is the can't replace archetype. The barrier here isn't the switching costs. Any client could, in theory, go and work with a different broker tomorrow. Instead, the barrier is that no other competitor sees as much of the global shipping market as Clarkson does. The more deals they see, the better their pricing intelligence becomes. The better the intelligence, the more clients want them in the room helping with deals. And the more deals they are party to, the better their ability to gather that pricing data. This is a self-reinforcing position or a virtuous cycle that makes the network almost impossible to replicate from scratch. You couldn't build it in a decade. Now, this is a much smaller position for the fund than Relics, not because our conviction is lower, but because Clarkson is a smaller company with limited share liquidity, which caps how much we could responsibly own. If it were a bigger company, we'd own lots more of it. It's exactly the type of business this philosophy is built around. The third holding that I want to discuss is L'Oreal, our largest consumer holding at around 5% of the fund. L'Oreal owns the broadest portfolio of beauty and personal brands in the world, across mass market, premium, professional, and luxury. Brands that you'll instantly recognize like L'Oréal Paris, Maybelline, Lancôme or Kiehl's, and many, many more. This is the can't emit archetype. The toll here isn't paid by the consumer, it's paid by the retailer. A supermarket, a department store, a pharmacy chain cannot afford not to stock the major L'Oreal brands. Because if they don't, consumers who came in for that specific shampoo or that specific moisturizer will go to the retailer that does. And this dynamic is global. It works the same way in a French hypermarket, an American drugstore, or a South African pharmacy chain. And what that produces is a steady stream of recurring revenue. People buy their product month after month, year after year, often keeping to the same brand for decades. This comes with low capital intensity, as L'Oreal doesn't need to build lots of factories or stores, so it can continue to reinvest capital and to build those brands. This is the toll road idea applied to something as mundane as a tube of lipstick. Now, these three holdings are illustrations, obviously not the whole portfolio, but you'll see the same logic at work across all of the other names that we own. In the payment networks, in financial market exchanges, in the global insurance brokers, or the branded consumer goods companies, or even a lot of the information and data utilities. For every name in the fund, there is a small toll that the customer pays for traveling on a road that they can't easily leave, and they pay it again and again and again. Now, just as importantly as discussing what we do own, let me briefly talk about what we don't. We don't own highly cyclical businesses where fortunes depend on the macro cycle, on commodity prices or capital spending swings. Now, as we've seen recently, these can be wonderful investments at the right point in the cycle, but they're not toll roads. The durability of their pricing power is often most at risk exactly when scarcity arrives, because customers are forced to either cut back or find alternatives, which leads to future competition. We also don't own capital-heavy businesses, where companies have to keep spending enormous sums on physical assets just to maintain that position. Because we believe in a high-rate world, businesses competing for scarce capital are at a structural disadvantage relative to those who don't. And we don't own businesses that rely on a specific regulatory or political outcome to succeed. These are often very hard to predict and can change very quickly. Subsidies can be withdrawn, tariffs imposed and overturned, and regimes themselves can change. Now, these types of companies particularly can look attractive in an individual year, but fundamentally, their toll roads are built on somebody else's land. Now, all three of these groups of companies can be excellent investments. They're just not investments for this fund. So that's the philosophy and the portfolio. But the obvious question to ask is whether it actually works, whether the businesses that we invest in really do behave the way our philosophy claims they should. Well, the good news from our point of view is that the real world has been turning up with some frequency over the past few years to test our thesis. Since 2001 alone, we've experienced one of the fastest rate cycles in 40 years, supply chains genuinely broken for the first time in a generation, war in Europe, a regional banking scare, major AI capex boom, tariff regulations, and now an ongoing Middle Eastern conflict. So a good test set to see how the company's performed. Well, what we have observed and what the bar chart here is showing is that the businesses we own kept growing steadily, quarter after quarter across the period. Not dramatically, not unevenly, and the bars show mid to high single-digit organic revenue growth in every quarter over the past few years. The line on the chart, you can see, is the price of the MSCI World Index, which has gone up, but been highly volatile, demonstrating the level of macro uncertainty that we've seen. So how did these companies achieve that? Well, what was going on underneath relates back to the three reasons we discussed previously. Complexity was driving customers towards the suppliers they already trusted. And across the portfolio, we've seen deeper customer relationships, higher renewal rates, and new business wins coming from competitors that have lost share rather than from the markets expanding. Our second observation is that pricing has held. When input costs spiked a few years ago, the businesses in the portfolio were able to put prices up modestly but repeatedly, and customers paid. Volumes have held, and margins for these companies even increased. Many businesses in the broader market tried the same thing and found their customers simply walked away. And the third thing we observed about this group of companies is that throughout this period, where large parts of the market were committing vast sums of capital, these businesses were able to continue to self-fund their own investments. They generated significant amounts of cash flow, invested sufficiently, and returned a growing and tidy sum to investors. It's worth saying briefly that this isn't a story about the past. The most recent set of results from the first quarter of 2026 looks in aggregate much like the ones that came before. In fact, with an ever so slightly higher organic growth rate. Now, I'm not going to pretend to know what happens next. Nobody does. But the texture of the world ahead, capital expensive, supply chains contested, geopolitics fractious and complexity rising, looks to me much more like the past 4 years than the relatively easy decade before. And if that's right, the businesses that quietly compounded through the recent stress should be well positioned to continue to do so. Not because we're calling any particular outcome, but because of the structural dynamics that protect them. Now, I'd like to spend the last few minutes on the question of what role a portfolio like this might play in the way you are building things for your own clients. Most of the wealth managers we've talked to in South Africa are running portfolios that already have meaningful exposure to local equities, local fixed income, and local currency. The global allocation, the offshore portion, is doing real work, not just geographic diversification, something structurally different. The first thing a strategy like this can do is diversify, and not just by geography. A portfolio of global toll roads isn't just exposure to different countries. It's exposure to a fundamentally different type of business to those that dominate the South African domestic market. The second role is that the strategy is resilient to the kind of global shocks that matter most and that we have seen occurring with increasing frequency, such as currency volatility or geopolitical shocks that compress trade. This portfolio isn't insurance against a particular outcome, but a hedge against the increasing complexity of world markets. The third role of the portfolio is as a steady source of compounding over time, one that doesn't depend on a specific trend remaining friendly. Most equity strategies are implicitly betting on something, be it falling rates, multiple expansion, sector rotation, or a very particular theme. A portfolio of toll roads is compounding from the businesses themselves. And for a client portfolio that needs to work over a period of a decade or two of unknowable conditions, we believe that's a genuinely useful property. It's also important to be clear about what this strategy isn't designed to do. This isn't a strategy designed to outperform in every kind of market. In years where speculative or deeply cyclical assets are running, a portfolio of compounders will often look quiet, even dare I say boring by comparison. But as a former software engineer, I would say that is a feature, not a bug. It reflects the fact that businesses aren't chasing cyclical drivers. This also isn't a tactical allocation. It compounds visibly over years, not months. So if you're looking for something to rotate in and out of as macro conditions change, this isn't really the right tool. And it's also not the whole answer. A diversified portfolio probably wants to include exposure to other things alongside it, emerging markets, fixed income, perhaps more cyclical equities. And I'm sure the Curate team will be more than happy to point you to the right complements. Now, this strategy is designed to be a compounding core, something a client can hold for a decade and largely leave alone, while the businesses inside it do their quiet work. And that brings us to the end. So thank you very much to Curate and to Natalie for hosting, and to you for listening. So let me close with what I think is the single most important thing to take away from this presentation. The conventional reading of choke points, the physical ones, the straits, the pipelines, the container routes, isn't wrong, but it's incomplete. The choke points that matter most, that compound returns over a decade and more, sit somewhere else entirely. The toll roads worth owning aren't on the map. They're in the invoice no one questions, the software no one replaces, and the brand that earns its shelf space every year. This is what the fund is built to own. And these businesses earn their right to charge these tolls most in a world of increasing scarcity and standoffs. Thank you.
Thank you, Chris. A really insightful perspective on the types of businesses that quietly sit at the center of the global economy. I think one of the most interesting points was that the strongest compounding businesses are often not the most obvious. Instead, they are the businesses customers cannot easily unplug, replace, or operate without, whether that is information platforms like Relics, infrastructure businesses such as Clarksons, or globally recognized brands like L'Oreal. What also stood out was the consistency and resilience of these businesses through periods of disruption. While markets and headlines constantly change, as we well have seen, businesses with recurring revenues, pricing power, and strong competitive advantages have shown an ability to continue to compound over long periods of time. Now, if I now briefly move over to the Curate Global Quality Equity Fund overview slide, this strategy focuses on investing in high-quality global businesses with durable competitive advantages and stable long-term earnings characteristics associated with the quality investment style. It has admittedly been a tougher environment for quality style investing over the recent periods, with markets favoring more cyclical and sexier AI areas of the market. However, that has also resulted in valuations within parts of the quality universe becoming increasingly attractive. The portfolio remains positioned around resilient businesses with strong balance sheets, recurring revenues, and long-term compounding potential, characteristics that we believe position the strategy very well for stronger outcomes over time. The fund also blends well with broader global portfolios, especially alongside growth or value strategies, helping investors diversify not just geographically, but by business model and investment style as well. That concludes Exhibiting Our Investment Artist webinar. We appreciate you taking the time to join us today and hope you found the sessions both insightful and thought-provoking. Please remember to complete the event survey before logging off, as your feedback plays an important role in shaping future events and content. If you have any further questions following today's session, please feel free to reach out to your Curate fund specialist. Thank you again for joining us, and from all of us at Curate Investments, goodbye.